You need to hear this today. Not tomorrow, not next week, today. If you own a home and you're 65 or older, there is a deadline coming up on May 21st that the IRS has quietly tied to a rule that most senior homeowners have never even heard of. And if you miss it, or if you don't know it applies to you, it could cost you thousands of dollars. Real money. Money that comes straight out of your pocket. Now I know that sounds alarming, and honestly it should, because what we're talking about today isn't some technicality buried in the fine print. This is a real situation affecting real seniors across the country right now. People who paid into this system their entire lives. People who did everything right, and they're still getting blindsided because nobody told them the rules had changed. So today, we're going to change that. We're going to walk through exactly what this deadline means, why it matters specifically to homeowners over 65, what the IRS is looking at, and most importantly, what you can do right now to protect yourself. Stay with me through the whole video because it builds. And what I'm going to share about 20 minutes in is something that most financial advisors aren't even talking about yet. Let's start from the beginning. Every year, the IRS updates what are called reporting thresholds. Basically, the minimum amounts that trigger some kind of review or action on your tax record. For most of your life, these thresholds probably didn't affect you much. You filed your taxes, maybe got a refund, and moved on. But here's where things changed. Under federal rules that went into effect quietly over the last 2 years, the IRS expanded the categories of income and financial activity that seniors are now required to report, or at least acknowledge, when they file. And this includes certain property-related income and equity events that happen to homeowners. Now, you might be thinking, I'm retired, I'm not selling my house. Why would any of this apply to me? That's exactly the problem. That's the assumption that's costing people money. Because the IRS isn't just looking at whether you sold your home, they're looking at a much wider range of activity, including home equity loans, reverse mortgage distributions, insurance settlements on your property, certain types of rental income, even the forgiveness of a home-related debt. All of these now fall under a broader reporting umbrella, and the deadline tied to many of these reporting requirements runs through May 21st for the current tax cycle. If any of these situations apply to you, and many of them apply to far more people than you'd expect, and you haven't addressed them on your taxes or flagged them properly, you could be looking at penalties. You could be looking at an audit. And in some cases, you could see an impact on your Medicare premiums. Yes, I said Medicare. We'll get to that. Let me give you a real example so this doesn't feel abstract. Imagine a woman. Let's call her Dorothy. She's 72, lives in a home she's owned for 28 years in a quiet suburb of Ohio. Her husband passed away 2 years ago, and she's been living alone on Social Security and a small pension. Her home has appreciated significantly over the decades. It's worth quite a bit more than what she and her husband originally paid for it. Last year, Dorothy's roof was badly damaged by a storm. Her homeowner's insurance paid out a significant settlement, enough to cover repairs and then some. She didn't think much of it because she used the money for exactly what it was intended for, fixing the house. What she didn't know is that a portion of that insurance payout might be considered taxable depending on how it's categorized. She didn't report it. Not because she was trying to hide anything. She just didn't know it needed to be reported at all. Now she's getting notices in the mail, and she's confused and scared because she's never had tax trouble in her life. Dorothy's situation isn't unique. Thousands of seniors every year walk into this exact trap, not because they're careless, because the rules are complicated, they change frequently, and nobody sends you a clear instruction manual. Here's something most people don't realize, and I want you to really let this sink in. The IRS has significantly increased the number of automated notices being sent to seniors in recent years. This is documented. They've improved their data matching systems, which means they can now cross-reference information from your mortgage servicer, your insurance company, your county property records, and your bank, and match it against what you put on your tax return. If something doesn't line up, the system flags it automatically. You don't get a warning. You don't get a heads-up call. You just get a notice in the mail, and suddenly you're playing defense. The May 21st date specifically relates to a window in the current tax cycle where the IRS is processing returns and matching data from Form 1099s tied to property and financial activity. If there's a discrepancy in your records and it falls within this window, the IRS has more time to pursue it before the typical review period closes. What that means for you practically is that this is the right time, right now, to make sure your records are clean, your filing is accurate, and if there's anything related to your home that happened in the last 12 to 18 months, you've addressed it correctly. Let's talk about reverse mortgages for a moment, because this is one of the biggest areas of confusion I see for seniors. Reverse mortgages have become very popular over the last decade, and for many seniors, they're a legitimate financial tool. The idea is simple. You've built up equity in your home over decades, and a reverse mortgage lets you access that equity as cash while you continue living in the home. But here's the problem. Many seniors who have reverse mortgages don't fully understand how the distributions are taxed, or in some cases, not taxed, and how those distributions should be reported. The distributions themselves are generally not considered taxable income. But the key word there is generally. There are circumstances where certain transactions related to a reverse mortgage or changes in the terms of the loan can create a taxable event. And if that's not confusing enough, the way your reverse mortgage distributions interact with your Medicare premiums is something almost nobody prepares for. Let me explain. Medicare uses something called IRMA, the Income-Related Monthly Adjustment Amount. It's a fancy way of saying that if your income goes above a certain threshold in a given year, your Medicare Part B and Part D premiums go up, sometimes significantly. Here's what catches people off guard. Even income that you think is not taxable, or that you think doesn't count, can still push you into a higher IRMA bracket under certain conditions. And once you're in a higher bracket, Medicare recalculates your premium, and you can end up paying hundreds of dollars more every month out of your fixed income. For a senior living on Social Security and savings, that's not a small hit. That's real money every single month. Now let's talk about something that could actually work in your favor, and this is the part I don't want you to miss. There is a provision in the tax code specifically designed for senior homeowners called the Section 121 exclusion. You may have heard of it referred to as the home sale exclusion. If you've lived in your home as your primary residence for at least 2 of the last 5 years and you sell it, you can exclude up to $250,000 in capital gains from your taxable income. If you're married or filing jointly, that number doubles to $500,000. That is a massive benefit, and many seniors either don't know it exists or don't know how to use it correctly. But here's where things get serious. The rules around this exclusion have gotten more complex. There are specific situations, including partial use of your home as a rental, certain types of home office use, or changes in your filing status due to the death of a spouse, that can reduce the amount of the exclusion you're allowed to claim. If you've made any of those changes in recent years and you're planning to sell your home, or if you sold your home recently and you're wondering whether you reported everything correctly, you need to know where you stand before the IRS comes to you first. The May 21st window is directly relevant here. Returns that reported home sale gains, or that excluded them under Section 121, are currently being matched against property records. If the numbers don't line up with what the county assessor or your title company reported, it creates a flag. I want to take a quick moment here because if you've been finding this information helpful, please take a second right now to hit that like button and subscribe to this channel if you haven't already. We cover these kinds of topics every single week. Social Security updates, Medicare changes, IRS rules that affect seniors, and we do it in plain English because that's what you deserve. Your subscription means more people like you can find this information when they need it most. Okay, let's keep going because we're not done yet. Let's talk about property tax exemptions because this is something that's genuinely underused by seniors across the country. Almost every state in the U.S. offers some form of property tax relief for seniors. Some states offer a flat exemption that reduces the taxable value of your home. Some offer a freeze, meaning your property taxes won't increase beyond a certain point even if your home's value goes up. Some offer a circuit breaker, which is essentially a refund or credit if your property taxes exceed a certain percentage of your income. These programs exist. They are real, they have real value, and a significant number of seniors who qualify for them never apply. Why? A few reasons. They don't know the programs exist, they don't know how to apply, or they started the process and found it confusing and gave up. Here's the urgency attached to this. Many of these state programs have their own annual deadlines. Some of them fall in May, some fall earlier. If you miss the deadline in your state, you typically have to wait until the next year to apply again. That could mean paying hundreds or even thousands of extra dollars in property taxes over the next 12 months that you didn't have to pay. So while we're focused on the IRS side of this, I also want you to check whether your state has a senior property tax exemption or freeze, and whether you've applied. If you haven't, call your county assessor's office this week. Tell them you're a senior homeowner and ask what programs are available. It's a 5-minute phone call that could save you real money. Now let's bring this back to Social Security, because everything connects. One of the things seniors often don't realize is that up to 85% of your Social Security benefits can be taxable depending on your total income. This is something that shocks a lot of people. They assume Social Security is tax-free. It's not, at least not entirely. The formula the IRS uses is called combined income. It's your adjusted gross income plus non-taxable interest plus half of your Social Security benefits. If that number exceeds $25,000 for a single filer or $32,000 for married filing jointly, some of your Social Security becomes taxable. Now here's how this connects to the homeownership issue. If you took a distribution from a home equity line of credit, received a large insurance payout, or had any other property-related income event in the past year, that income can push your combined income higher, which means more of your Social Security becomes taxable, which means a higher tax bill at the end of the year, even if you didn't feel like you had more money coming in. This is what I mean when I say these things are all connected. The IRS doesn't look at each piece of your financial life separately, they look at everything together. And when you're a senior with multiple income sources, Social Security, maybe a pension, maybe some savings withdrawals, maybe a home-related event, the picture gets complicated quickly. Here's something practical you should do before May 21st. Pull out your records from the last 12 to 18 months and go through this simple checklist in your head. Did you receive any insurance payouts related to your home? Did you take any money out of a home equity line or a reverse mortgage? Did you sell any property, even a partial interest in a property? Did you receive any forgiveness on a home-related debt? Did you rent out any part of your home, even temporarily through a service like Airbnb? Did your filing status change due to a spouse passing away? If the answer to any of those questions is yes, and you haven't specifically addressed those events with your tax professional or on your tax return, you need to follow up. Not eventually. Now. If you already filed your return for this year and something was missed, you may still be able to file an amended return. This is called a Form 1040-X. Filing an amended return proactively, before the IRS catches a discrepancy, almost always puts you in a better position than waiting for a notice. And if you haven't filed yet and you're waiting on an extension, use that time wisely. Don't just use the extra time as a reason to put it off. Use it to make sure you have all of your property-related documents in order. I also want to spend a few minutes on something that doesn't get enough attention, the emotional side of all of this. When seniors get a notice from the IRS, or when they realize they may have made a mistake on their taxes, the reaction is often fear and shame. And that fear can cause people to freeze up. They don't open the letter right away. They don't call a professional. They hope it just goes away. It doesn't go away. The IRS has very clear procedures, and ignoring a notice is almost always the worst thing you can do. The penalties and interest that accumulate on unresolved issues can grow quickly, and what might have started as a small discrepancy can turn into a much larger problem if it isn't addressed. So if you receive any communication from the IRS, anything at all, open it, read it carefully, and if you don't understand what it's asking for, call a tax professional. If cost is a concern, look into the VITA program, Volunteer Income Tax Assistance, or the AARP Tax Aid Program. Both provide free tax help to seniors, and they have people who deal with exactly these kinds of situations regularly. You don't have to navigate this alone, but you do have to take action. Let me give you one more layer to this story, because there's a development happening right now that I think is important context. Over the last year, the IRS has received significant additional funding for enforcement. And while there's been a lot of political debate about how that funding should be used, one of the areas they've specifically flagged for increased attention is unreported or underreported income from property and real estate transactions. That includes home sales, equity events, and insurance-related property income. Exactly the categories we've been talking about today. This isn't speculation. The IRS has published guidance on this. They've expanded their information matching programs, and the enforcement activity targeting these areas is expected to increase significantly over the next 18 to 24 months. What that means for you as a senior homeowner is that the window of getting away with an honest mistake is getting smaller. Not because the IRS is targeting seniors unfairly, they're not, but because the systems are simply getting more accurate. The gaps that used to exist between what was reported to the IRS and what appeared on your tax return are closing. The smartest thing you can do right now is get ahead of it. Make sure your records are clean. Make sure your return is accurate, and if there's anything you're not sure about, ask someone who knows. Before I wrap up, I want to talk briefly about one more protection that too few seniors use. If you've had tax issues in the past, or even if you haven't, the IRS has a program called the Taxpayer Advocate Service. It's an independent office within the IRS that exists specifically to help taxpayers who are experiencing hardship or who feel like they're not getting a fair resolution through normal IRS channels. If you're a senior on a fixed income and you receive a tax bill that you genuinely cannot pay, or if you're in a situation where an IRS action is causing significant financial harm, the Taxpayer Advocate Service can intervene on your behalf. This is a free service. It's run by the federal government, and it exists specifically for situations like the ones we're talking about today. The number to reach them is 1-877-777-4778. I'd encourage you to write that down. You may never need it, but it's good to have it. Let's bring this all together. We started today talking about a May 21st deadline and how it relates to senior homeowners and the IRS, and we've covered a lot of ground since then. Reporting requirements for property income, reverse mortgages, Medicare premium impacts, the Section 121 home sale exclusion, state property tax exemptions, Social Security taxation, and the emotional and practical steps you should take to protect yourself. Here's the core message I want to leave you with. The rules around taxes, Medicare, and Social Security are not static. They change every year, and they interact with each other in ways that aren't always obvious. Being a homeowner adds another layer of complexity, because your home isn't just where you live, it's a financial asset, and the IRS treats it that way. You have worked your entire life to get to where you are. You paid into this system. You built equity in your home over decades. You deserve to keep as much of that as the law allows. But protecting what you've earned requires staying informed and taking action before problems find you. So here's what I'm asking you to do after this video ends. Check your records for any property-related financial events from the last 18 months. Verify that those events were properly reported on your taxes. If you're not sure, talk to a tax professional or contact a free service like AARP Tax Aid. And if you qualify for a state property tax exemption, apply for it before your state's deadline. These are not complicated steps, but they are important ones. And taking them now, before May 21st, before a notice arrives in your mailbox, could save you thousands of dollars and a whole lot of stress. If this video helped you today, please share it with someone you know who owns a home and is 65 or older. This is exactly the kind of information that doesn't get shared enough, and the people who need it most are often the last ones to find it. Subscribe to this channel so you never miss an update. We're here every week with information that is designed specifically for seniors. No jargon, no confusion, just clear and honest information about the rules and benefits that affect your life. Thank you for watching. Take care of yourself. And remember, staying informed is the single best thing you can do to protect everything you've worked so hard to build.